So it's not an issue of how much gold a central bank has. The issue is, do people trust that its liabilities, which are its currency, the currency is a liability of the central bank. That's the definition of what a currency is. Are the people going to trust that if they hold this paper liability of that central bank, that they can redeem it for the gold that's on the central bank's balance sheet? I don't think anyone would say that that is even remotely possible. It's not. So I don't think it even matters at all how much gold or silver or real assets a central bank even has. Because once they destroy the currency, the faith in the liability issuing group, which is the central bank, will be lost.
Strong central bank purchases of gold are expected to continue unabated, helping to offset any negative impact a strong dollar might have on price. Central banks, notably those in emerging markets, have been net buyers of gold every year for the past 15 years to diversify their dollar-heavy reserves. The pace of their purchases began to pick up when trade tensions between China and the U.S. worsened during the first Trump administration. That laid the groundwork for a more pronounced trend among countries to view foreign exchange diversification as a matter of national security. Rafi Farber, a seasoned monetary analyst, gives his insights into precious metals and economic trends. While reflecting on the market, Rafi Farber argues that central banks buying gold has little impact on restoring trust in fiat currencies. He explains that once faith in the currency is lost, central banks would need to make it convertible to gold, which requires halting inflationary printing. Lower interest rates are favorable for gold since they increase the money supply. More dollars chase fewer goods and services, causing currencies to lose their value. Gold retains its intrinsic value, which means investors need more dollars to buy the same asset. Since 1973, gold has posted average cumulative returns of 133% during U.S. dollar bear markets and -9% during periods of dollar strength. History suggests that the benefit of holding gold to protect against currency weakness over the long term can outweigh any drag from currency strength. In fact, the U.S. dollar is as strong today as it was at the turn of the century, while gold has appreciated 813% in the same period. In his analysis, Rafi warns that central bank digital currencies destabilize the financial system. However, Farber hopes the system collapses before CBDCs gain widespread traction. Now, we present the clips of Rafi Farber's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
If you imagine digital currency as the next step in the pyramid, which is what it is, let's take a step back for a second, right? Speaking from an economic praxeological Misesian, perspective here, there's no difference economically between the digital dollar that we have now and a central bank digital dollar, or the rupee that the digital rupee that Indians have now. They have phones, they have the internet, they have a digital number in their bank account that isn't backed by paper rupees. They have a digital rupee already. It's just what they call a digital rupee is just a better way to track financial transactions. So we're not talking about a new currency here. We're talking about a derivative on top of an existing currency that's just really good at spying on you and spying on everything that you do. So look, on the one hand, this is terrifying. It's very terrifying. I would stay away from central bank digital currencies, meaning blockchain, government-controlled blockchain it would be a better word for it. It doesn't, central bank digital currency kind of obfuscates the issue. We're talking about a government-controlled blockchain where they can see everything that you've ever done with this dollar, or anything that anyone's ever done. I would avoid it as much as possible, but I wouldn't let it get to me and think that another layer in the pyramid can stretch out the system much longer. Right? You build another floor on the pyramid, it's going to make it even less stable. So I'm hoping these things do not last very long. I'm hoping that everything ends before they really gain any traction. And the more traction they gain, the faster it's going to fall. So the issue of central banks buying gold. So let's put it into perspective, right? It's when central banks buy gold to back their currencies, central banks print currency a lot faster than they can possibly accumulate any gold. And I'm not saying they're not accumulating gold, but sometimes, and I don't know about India's case specifically, but when gold bugs tend to talk about central banks buying gold, and then this is going to raise the gold price and we're going to be rich. I mean, if you look at a central bank like Turkey, they buy gold, they sell gold. They buy gold, they sell gold. It goes up and down. It's crazy. And who wants the Turkish lira? Nobody wants it. Right? It's dead. And it didn't matter how much gold that they bought. So it's not an issue of how much gold a central bank has. The issue is, do people trust that its liabilities, which are its currency, the currency is a liability of the central bank. That's the definition of what a currency is. Are the people going to trust that if they hold this paper liability of that central bank, that they can redeem it for the gold that's on the central bank's balance sheet? I don't think anyone would say that that is even remotely possible. So I don't think it even matters at all how much gold or silver or real assets a central bank even has. Because once they destroy the currency, the faith in the liability issuing group, which is the central bank, will be lost. And they'll have to make it convertible if they want people to use their disgusting inflated paper. And in order to make it convertible, they've got to stop printing. And if they're going to stop printing, they're going to have to allow their banking clientele buddies who they control, they're going to have to allow them to crash and fail. So if the bank's clients get in trouble and they need inflation and they can't get it because the central bank is saying, oh, well, we have to restore confidence in our currency, so we can't inflate anymore. Well, then the Federal Reserve Board, or whatever the equivalent of that is in India, could get lynched. It's very possible.
During the interview, Rafi Farber explained that the spread between Treasury yields has returned to positive territory. He believes this is correlative, not causative, signaling tighter monetary conditions and rising debt defaults. The closely watched part of the Treasury yield curve between 3-month bills and 10-year notes also turned positive for the first time since November 2022. Possibly indicating that a U.S. recession is getting closer, as per the Reuters report. In August 2024, J.P. Morgan analysts predicted a 35% chance of a U.S. recession by year-end and a 45% probability by the end of 2025. Although the market will eventually face a downturn, predicting its exact timing is near impossible, and trying to do so can disrupt investment strategies. An analysis from the Center for American Progress, CAP, warns that Project 2025, a far-right initiative, could trigger a financial crisis similar to the 2007 and 2008 recession, severely harming workers and the economy. Moving forward, Farber predicts the next recession will surpass previous crises in severity due to unprecedented debt levels, emphasizing that the impact will depend on individual financial positioning. Let's get back to the interview.
The spread between the 10-year and the 3-month treasuries, Treasury bills and Treasury notes, is now, I'm looking at it on Fred right now, it's 0.06. So you get 0.06, you get 6 more basis points of yield for lending out your money for 10 years than you do for lending it out for 3 months, which this is not quite normal, but it's above zero at least. It acknowledges that at least we're mortal, but if you only get 6 more basis points for lending out money for 10 years and you do for 3 months, then I guess, our lifespans would be like maybe 2,000-3,000 years, something like that, whatever. But the point is, okay, getting back to Earth here, or wherever it is we are. What I did is I took a look at the 10-year minus 3-month yield spread, and I looked at the recession shaded areas. And the last 3 recessions, we have 1990, 2001, and 2008, which we all know about. It's somewhere between 3 and 6 months from when the spread goes back above zero to when the next recession is triggered. And the question that people ask me is this organic or is it causative? Is it that we're ending this printing cycle? Could be. So is it causative? Is it that the yield spread goes above zero and therefore that triggers a recession or triggers a financial crisis? Or is it just correlative, right? That the fact that money is tightening means that interest rates are going higher, right? If interest rates are higher, less people are going to borrow money, and then you're going to have less grease in the wheels of the Keynesian economy. And then that's when debt starts to default. Then you have the slowdown, then you have the crash, and that's when all purchasing power kind of flows into gold and silver. Whether it goes up and down in dollar terms is a separate issue. And I don't think it's causative. I think it is it's just correlative. That when you start seeing the yield spread go above zero and go higher and higher and higher, that means that interest rates, that longer term interest rates are rising, which means money is getting tighter. It costs more to borrow, which means money's running low, right? And when you ask the question, when the Fed cuts interest rates, right, does that cause a higher money supply, or does the bigger money supply cause the cut in interest rates and the Fed's just following it down? And it's really a chicken and egg question. But what we do know is that when longer term interest rates are higher, then the money's starting to run out. And finally, that is what is happening. And judging by history since 1990, which is really when the fiat system started to heat up, right? If we count the beginning of the fiat monetary system in 1971, then really from 1971 to about 1980, 1985, like the central bank was still trying to gain control of the system. It didn't really have it yet. And then by 1980, 1985, they were able to like gain control of it as to where we are now and get things going. And now we're at the end of the ride here. So counting from 1990, when the fiat system, the fiat dollar standard, as we were all familiar with, started to really gain some strength and gain some momentum, then from that system on, we have about historically 3 to 6 months before the next recession is triggered, and the strength or the severity of that recession, financial crisis, these are all the same words, will be in proportion to how much debt is going to default and how many people that thought they had money no longer have any. And this is going to be worse than, or better, depending on where you're positioned, right? It's going to be worse if you don't have money. It's going to be better if you do, than any other recession that we've ever seen or experienced, I think, in American history or even world history, because we've never done anything like this before.
As we move into 2025, gold continues to solidify its position as a reliable investment and cherished ornament. Industry leaders and analysts are optimistic about the precious metals outlook, citing factors like inflation, geopolitical risks, and evolving market dynamics. How do you think central banks' gold purchases influence trust in fiat currencies? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.